Hey everyone, in this video I'm going to bring you one growth stock that's down 38% that I think makes an excellent investment today. I'll share with you what the stock is, the good characteristics about it, one big risk, and why I think it's a good value at current valuation. So let's jump right into it. Let's see what the stock is.
I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.
Alright, the stock that I'm talking about in this video today and recommending is AppLovin, the supply side advertising platform. I think the stock makes an excellent investment at current valuations, and I think it's a buy today, as I've signaled here in this slide. Now, the stock is down 37.8% off its high that it reached in late 2021, but it is rebounding strongly off the bottoms reached around January of 2023. It's recovered significantly. It used to be down over 100%. It's now only down 37.8% off the high. So it has recovered, it has bottomed, and is rising given the company's excellent performance in recent quarters, which I'll share with you here. So management said that total revenue for 2023 came in at 3.3 billion, which was up 17% year over year, and net income of 357 million with a net margin of 11%. The cash flow from operations came in at 1.1 billion, which was up 157% year over year, and free cash flow of 1 billion was up 167% year over year. Management is using some of that cash that it generated to buy back shares. It's already bought back roughly $1 billion worth of its own stock, and it increased its share buyback program of up to 1.25 billion. As the company reduces the share count, it increases the earnings per share because you have net income divided by the number of shares outstanding. So if you reduce the number of shares outstanding, net income is going to be divided by a smaller number, and so earnings per share is larger as a result. It also signals that management thinks the stock is undervalued. If management is willing to spend $1.25 billion of its own money, of the company's money, to buy back its shares, it signals that it thinks the stock is undervalued. And it's not just going out and talking about it, right? Like so many CEOs do when they're trying to hype up their stock. No, they're going out and they're spending $1.25 billion in cash money to buy back shares. Now, that's a strong signal that is not faked, right? They can't fake that. Whereas if you just go out, anybody can just go out and talk about how they think their stock is undervalued, how investors should buy their company and invest in their company. All the while, they're not spending any money. It's just words, right? Anybody can say words. And so it's cheap to go out and talk. But when you spend $1.25 billion, that's hard to fake. Also, management forecasting the next quarter, 965 million in revenue at the midpoint. That would be incrementally up from 953 million in the most recent quarter. So not only are they performing well, but they think this performance will continue at least into the next quarter. Now, the advertising industry is cyclical in nature. When the economy does well, the advertising industry does well. Digital advertising even more so, but digital advertising has a strong tailwind behind it because more and more advertisers are moving to digital advertising because it's more measurable. It's more measurable. You can determine how many people clicked on your advertisement and purchased something. And so you can see if you're getting a good return on investment versus if you advertise, let's say, on a billboard in Los Angeles. How many people saw your billboard? Who knows how many people saw your billboard? You can make rough estimates like, well, the population of Los Angeles is 11 million and they drive on this street ever so often and this many people saw your platform. But that would be highly uncertain and imprecise to be kind. But online digital advertising, you can get real precise with the measurements and it's more effective. And over the years, more and more dollars are moving towards digital advertising, and that's going to work in AppLovin's favor as it has the supply side. It has the supply of digital advertising and buyers are coming in, increasing demand for that product. But if there is a downturn, if there is a recession, that's not going to be good news for AppLovin. That's going to decrease demand from marketers for all advertising, not just digital advertising, and AppLovin could experience a decline as a result. But all indications point to a very strong economy so far in 2024. In fact, much better than I was anticipating coming into the year. I was anticipating GDP growth of anywhere between 1% to 1.25, 1.35%. I've since revised my expectations higher to GDP growth of between 1.8 to 2% real GDP. So I've significantly upgraded my GDP expectations for the year. I've downgraded the amount of interest rate cuts I expect in the year, and all things look to be better in terms of the macroeconomy compared to what I anticipated to enter the year. So all those are good things for AppLovin. Now, longer term, AppLovin, its cash flow from operations to sales has increased to 32.33%, up from roughly 16% in late 2021. So as it's growing its revenue, it's able to generate stronger cash flow from operations to sales. It's a relatively light asset business model. It doesn't invest so much capital. It doesn't need to invest so much capital into the business to generate this revenue. And so more of the revenue that comes in gets to flow to cash flow from operations. Now, I did highlight that I would discuss one of the risks of the business, and that is the balance sheet. The company has 500 million in cash and over 3 billion in long-term debt, So a little bit of a misbalanced situation there in terms of cash to long-term debt, but given how strong its ability to generate cash is, it can always use some of that cash to pay down the debt if it felt the need to. Right now, it feels like buying back its stock is a more effective use of capital than paying down its debt. Over time, that might change. It might not. Management has the flexibility because it generates so much cash. When you have so much cash, you have options. When you're desperate, you don't have options. So this is a risk right now, but it's not that large of a risk because it generates so much cash. If that cash generating ability were to collapse, then this risk would be magnified. So it's something to pay attention to as a potential risk, but as of right now, this risk is relatively dormant. And as it's increasing its revenue, it's increasing its return on invested capital. ROIC has jumped from negative 5% up to 7.58%. I would like to see this number move above double digits over the next 4 to 8 quarters. And the trend is that it is moving upward. It's still very low. Well, I wouldn't say very low, but it's still lower than I would like. But I like that it's moving higher quickly. This is an important metric that I consider. 7.5% is below the areas I like to see, but it is moving in the right direction, so that is good news. And the analysts on Wall Street that are following AppLovin stock, they expect it to increase the earnings per share by 20% per year for the next 5 years, nearly double the rate of the average stock in the S&P 500. So AppLovin has significantly above average growth in profitability in line expected over the next 5 years. And finally, the valuation is not expensive. It's trading at a forward price to earnings of 13.46, which given all the metrics that we considered is cheap given the characteristics of the business, the strong cash flow from operations, the revenue growth, the expected 20% per year in EPS expectations, the industry secular tailwind, all of that suggests that the valuation I would be willing to pay for would be much higher than where it is today. In fact, I would be willing to pay a forward PE for AppLovin up in the high teens, 18, 19 even. Forward PE I would feel like would be a good value for AppLovin, but you're able to get it today at a forward PE of just 13.46. So for all those reasons, I think AppLovin is one growth stock that makes an excellent investment today. It has risks, it has tailwind, it has headwinds. Just like every equity investment, every stock investment has risk. You could lose your money. That's the risk with making investments. So I wouldn't advise investing any money in any stock really that you're going to need in the relatively near term, like in the next couple of years. If you're going to need that money for anything else, I wouldn't use it to invest in stocks because there is the risk of losing that money. So only invest money that you can afford to lose and you won't need in the next few years. Did you know that over 90% of the people that watch my channel are not subscribed? It'll really help support my channel if you hit that subscribe button. And oh, by the way, one of the benefits of being subscribed is that I take requests from subscribers more often than I do from non-subscribers. So if you prefer that benefit, please subscribe to the channel.